Hello everyone, this is Sebastian McMahon from IA Financial Group, and I'm back with the weekly economic review for the week ending August 30th, 2024. So a very calm week on the macro front in the markets. We'll discuss the highlights of the week, but in the markets, it was the NVIDIA week. We had the earnings from NVIDIA on Wednesday at 4:20 p.m. Everyone in markets were looking at that. And interestingly, NVIDIA beat by a fair margin, had a strong guidance, but it didn't beat enough. So markets were a bit disappointed and the stock was lower in the end, and Nvidia and rather the Nasdaq is having a negative week. So this is very interesting in terms of leadership change in the markets. Markets have been volatile in August, but interestingly the equal weight index on the S&P 500 pulled back by less than the Nasdaq during the correction at the beginning of the month, and has made new highs earlier than the Nasdaq. We're seeing some sectors that were left for dead that are starting to perk up. We're seeing home builders do well with anticipation of rate cuts in the US. We're seeing utilities do well. So we're seeing this rotation of leadership under the hood, which could be a good thing, could bring some stability to the market till the end of the year. So maybe the index, at the index level, you won't see returns that are as strong as in the beginning of the year, but it's a great environment for stock picking. So for active management, we're heading into such an environment. When we look at this week's markets at the close on Thursday, so negative for bonds. Also, the rates fell by quite a bit in the last few weeks. Now we're starting to lose some of those gains. Market is looking for the equilibrium rate here. In the stock market, negative except for EFI, but the Nasdaq was the most negative of all, as I mentioned, because the narrative around AI and tech is getting more balanced. Yes, it's going to change the world. Yes, lots of money is going to be going to the pockets of these businesses, but also what are the risks? Are we overpriced? So this is the thinking that's starting to make the rounds here in the markets. Oil higher, USD CAD, the Canadian dollar versus the USD higher, euro lower, and the price of gold 0.35% higher. And interestingly, that's still the best performer on the year with 22%. So going to the macro here in the US, the latest inflation figures are confirming the green lights for the Fed. The green light was already given by the speech from Mr. Powell at Jackson Hole last week. So we discussed that. There's no surprise here. But the Fed says that it's data dependent. But so here's the data. The core PCE, which is the main indicator of inflation for the Fed, is sending a signal that all systems are go. On the left, you have year-over-year total in core, so slowing down healthily. And on the right, if you look at a 3 months annualized figure, you're at 0.9% pace for total. So inflation is slowing down at a fast enough pace. So it's time to go on with those cuts. Before we go into the pricing for the Fed, let's look at maybe just one data point for Europe. This week we had data on the credit cycle, and I like to look at credit because credit is the lifeblood of the economy. When households make important decisions like buying a house, furniture, a car, usually credit is involved. When businesses are investing, usually credit is involved. So on the left, you see it's a very nascent turn here of the credit cycle. There's a risk that is just a head fake, but it's a positive enough sign that we perk up and start. Maybe we've seen the bottom of the credit cycle here, and we're about to get to an acceleration. And you have the US, you have the Eurozone, and China as being the three largest economies in the world. And as long as you have 2 out of 3 that are doing well, generally the global economy does fine, the global manufacturing cycle does fine, and there are some positive trickle-down effects for markets and for other countries. Now, if we see here the European credit cycle starting to perk up, maybe that means that we could be on the verge of some reacceleration in Europe. If you look on the right, this is Germany. So I picked Germany as this is pretty much the economic engine of Europe. You see that over the last quarters, it's been pretty much up, down. Since 2022, pretty much zero growth in real terms. Credit cycle, if it reaccelerates, maybe that gives us the signal that the next few quarters could be better for Europe, and that could do some good, that could have a very positive impact on the global macro landscape and on the markets incidentally. Central banks now, synchronized cuts are coming outside of Japan. So you have the Fed, you have the Bank of Canada, you have the European Central Bank and the Bank of Japan. All of the next meetings are here, and what you see here are the odds that are priced into the markets that we see cuts. So as you can see, Fed, lots of cuts coming in. Bank of Canada, almost a certainty of cuts coming in for over the next 4 meetings, starting next week, where we are expecting a rate cut. ECB, bottom left, you see that market is pricing in rate cuts also as far as the eye can see. BOJ, it's a different story. They didn't hike during the pandemic. Inflation now is starting to accelerate with all of the structural reforms that they're seeing. The labor market is getting tighter, so we're seeing good things here. But the market is not yet pricing definitive cut, but it's thinking hikes rather. But it's looking, it's headed in a different direction, and it could create some more macro rooted volatility as we've seen in early August. But now what's priced in now? Where did the liquidity go? Maybe now we're less vulnerable to these divergences. Looking now the road to the U.S. presidential election, I'll try to cover it every single week until we reach the election. Well, here on the left you have the polls. Mrs. Harris is still leading Mr. Trump in the polls. The bettors market on the right from predicted is also favoring Mrs. Harris over Mr. Trump. But when you look at the swing states now, the very latest polls that we've had this week seem to show that we're shifting towards Mrs. Harris, but we need to look at the long-term trends. So we need to look at maybe a week of data and have multiple polls before we go with such a conclusion. But it seems that the honeymoon phase with Mrs. Harris is continuing. So her odds are rising. But when you look at the Electoral College, remember that in the U.S., for every state except 2, except Nebraska and Maine, when you win the popular vote in a state, you get all of the voters of that state. So it's an Electoral College system. And as of now, it's still leaning towards a Donald Trump win. So Mrs. Harris still has some work to do, even though here the polls seem to favor her. When you look at what is the most likely scenario, well, the chart that you see here shows that the most likely outcome is we have a divided government. Whether it's Mrs. Harris or Mr. Trump that wins, when you look at the Senate, the odds are very high that it's going to be staying with a Republican majority. And for the Congress here, we should have, the odds are favoring the Democrats. So whoever wins at the presidency, we should have a divided government, which means less sweeping reforms, let's say, less noise coming from Washington, and usually markets tend to prefer that. So we could have more status quo here. So I would say divided government usually are what you want if you're an investor, and this is the most likely scenario now, according to the better odds. Now, what we'll be watching next week, Bank of Canada rate decision. We said that we will be falling off our chair if we don't have a rate cut. It's pretty much priced in fully. It's pretty much been flagged. We expect rate cuts in on September 4th, in October, in December, and in January. And after that, we'll see, how the message from the bank evolves. But I think that the path has been set by the bank. We have the employment report. We should have a rebound in jobs creation. We should have a higher unemployment rate at 6.5%. We have in the US ISM manufacturing and services. One should rebound, the other should fall a little bit. Non-farm payroll. Now the market is getting pretty sensitive to labor market data. Last month we had a low report. It was tainted by the hurricane. BLS said it didn't have much of an impact, but we'll see. Maybe we could have a rebound here, and maybe that could create some volatility in the market. So just keeping that in mind, that there's a potential volatility, macro volatility event next week if we have too hot of a labor market. And the unemployment rate should be down a little bit at 4.2%. So that wraps it up for the week. Always a pleasure to serve you. If you enjoy the content here, please share, and of course come back again next week.